Two men, same age, same city, same income, same exact starting point in life. Both have $50,000 saved. Both make around $55,000 per year. Both want financial freedom, but they choose completely different paths. One buys a rental property. The other buys index funds. 20 years later, both of them become wealthy. But one of them spends years handling tenants, repairs, stress, debt, and unexpected costs. The other spends most of those years barely thinking about investing at all. So who actually made the smarter decision? That depends on whether you care only about returns, or whether you care about time, stress, risk, freedom, and what your life actually looks like while building wealth. Because the internet loves simple answers. Real estate is the best investment. Stocks always outperform. Passive income, cash flow, compounding. Everybody has a favorite side, but almost nobody includes the full picture. They show you the exciting numbers, the clean math, the success stories, but they leave out the hidden costs, the emotional pressure, the bad years, and the things that quietly destroy returns. So in this video, we are going to do something different. We are going to compare real estate and index funds honestly, not emotionally, not politically, not based on social media opinions, just real numbers over 20 years. And by the end of this, you will understand something most investors never fully realize. The biggest difference between these two investments is not the return. It is the lifestyle that comes attached to the return. So before we dive in, I want to know a little about you. Drop a comment below and tell me, how old are you? Where are you watching from? What do you do for a living? And honestly, how satisfied are you right now with your income, investment, and overall financial situation? No judgment, just real answers. Because the more honest you are about where you are, the easier it becomes to move forward. So let's get into them. So with that said, let's get started. Let's start with Kevin. Kevin has always loved real estate. To him, property feels safe, real, tangible. You can touch it, drive past it, improve it, show it to people. And deep down, owning property feels like success. So Kevin takes his $50,000 savings and uses it as a 20% down payment on a $250,000 rental property. A basic 3-bedroom house in a decent middle-class neighborhood. Nothing luxurious, just a solid rental. He gets a 30-year mortgage at 7% interest. His monthly payment is around $1,330. After buying the property, he quickly finds tenants willing to pay $1,800 per month in rent. On paper, Kevin sees this: $1,800 rent minus $1,330 mortgage equals roughly $470 per month. Almost $500 monthly profit. That sounds incredible. And emotionally, Kevin feels amazing. He tells his friends he became a real estate investor. His parents are proud. His co-workers are impressed. When he drives by the property after work, he smiles and thinks, I own that. And honestly, this matters more than people think, because investing is emotional. People pretend investing is pure logic, but it is not. How an investment feels affects how long people stick with it. And real estate feels powerful. Now let's look at Messi. Messi takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no property, no exciting announcement. No one congratulates him. No one cares. Then he sets up automatic investments of $300 per month and basically moves on with his life. When people ask what he invests in, he says, mostly index funds. The conversation usually ends there, because index funds are boring. You cannot drive past an index fund. You cannot show it to your friends. You cannot post a picture beside it on Instagram. It is just numbers on a screen. And this is one of the biggest reasons people underestimate stock investing. Because boring things often become powerful very slowly. During the first year, Kevin feels like he absolutely made the right decision. Every month rent arrives in his account. He starts learning about tax deductions, mortgage interest deductions, depreciation, property appreciation, equity growth. It feels like he discovered a secret rich people have always known. And honestly, for a while, everything works smoothly. Meanwhile, Messi checks his investment account maybe once every few months. His portfolio goes up, then down, then up again. Year 1, his $50,000 becomes roughly $55,000. Nothing exciting, no dramatic moment, no feeling of progress. And psychologically, this is difficult because humans love visible progress. We love action. We love activity. Real estate gives you activity constantly. Stock investing mostly gives you silence. But now, let's move beyond emotions and talk about actual numbers, because this is where things become interesting. By the end of year 3, Kevin has collected around $64,800 in total rent. That sounds incredible. His mortgage payments over those 3 years total around $47,880. At first glance, it looks like he made almost $17,000 in profit. And this is exactly where most real estate versus stocks conversations stop. But real investing begins after the simple math, because now reality arrives. Property taxes cost Kevin around $3,000 per year. That is $9,000 gone over 3 years. Insurance costs another $1,500 annually. Now another $4,500 disappears. Then one winter the water heater fails. That repair costs $1,200. A year later, heavy rain reveals a roof leak. Another $2,800 gone instantly. Then one tenant moves out unexpectedly. The property sits empty for 1 month. Kevin loses $1,800 in rent, then spends another $600 cleaning, repainting, and relisting the property. And remember, Kevin manages everything himself because he wants to save money. That means late-night phone calls, weekend property visits, tenant complaints, contractor coordination, stress during vacations, interruptions during dinner. The investment is making money, but it is also demanding attention constantly. And this is the part many people ignore about rental properties. If you self-manage, you save money but sacrifice time. If you hire property management, you save time but sacrifice profit. Either way, something gets spent. By the time Kevin subtracts all real expenses after 3 years, his actual cash flow profit is probably somewhere between $2,000 and $4,000, not $17,000. And definitely not the easy passive income social media promised him. Meanwhile, Messi invested his original $50,000 plus another $10,800 through monthly contributions. Assuming an average annual market return near 10%, his portfolio is now worth around $76,000. No tenants, no repairs, no emergency phone calls, no stress. But Kevin still has one huge advantage Messi does not: leverage. This is the single most important reason real estate can outperform stocks. Kevin used $50,000 to control a $250,000 asset. Messi used $50,000 to buy $50,000 worth of investments. That difference changes everything. Because if Kevin's property rises only 3% annually, the appreciation happens on the full $250,000 value, not just his $50,000. After 3 years, the house might now be worth around $275,000. Meanwhile, tenants have been helping pay down the mortgage balance. Kevin's equity could now be somewhere between $60,000 and $70,000. That is real wealth growth, and much of it came from using the bank's money. This is why real estate creates so many wealthy people. Leverage magnifies gains, but leverage also magnifies stress and risk, because debt works beautifully when things go right, and painfully when they do not. Now let's talk about the costs nobody includes in the glamorous real estate stories online. Vacancy. Every rental property eventually sits empty. Even one empty month hurts badly because the mortgage still exists whether rent arrives or not. Maintenance. Every property slowly breaks. Appliances fail. Pipes leak. Air conditioners stop working during heat waves. A common rule is saving 1% to 2% of the property value yearly for maintenance alone. On a $250,000 house, that could mean $2,500 to $5,000 annually. Then come capital expenditures. These are the giant expensive repairs people forget to budget for. Roofs, furnaces, foundation issues, driveways, electrical systems. These repairs do not happen monthly. They happen suddenly, and they can wipe out years of profit instantly. Then there are bad tenants. And this is where investing suddenly becomes emotional very quickly. Imagine someone stops paying rent. Now you still owe the mortgage, still owe taxes, still owe insurance, but no money is coming in. Evictions can take months. Legal fees pile up. Property damage sometimes follows. One terrible tenant can destroy an entire year financially. And yet none of these risks appear in the flashy cash flow numbers people post online. By year 5, Kevin understands real estate much differently than he did at the beginning. He is now on his 3rd tenant. Insurance costs increased. Property taxes increased. Maintenance costs increased. One roof replacement alone cost him $8,500. A plumbing emergency cost another $1,400. Yes, rent increased too, but so did almost every expense attached to the property. And this is an important truth. Real estate is not passive income. It is semi-passive business ownership. There is a huge difference. Meanwhile, Messi continues doing something that feels completely unremarkable. He keeps investing, month after month, without excitement, without drama, without trying to predict the market. And around year 7, something interesting begins happening. Compounding becomes visible. His portfolio reaches somewhere between $135,000 and $150,000, and suddenly the gains themselves start creating meaningful growth. This is the strange thing about compounding. At first, it feels useless. Then eventually, it feels unstoppable. Because in the beginning, your contributions matter most. Later, your money begins working harder than you do. And eventually, growth starts accelerating almost automatically. By year 10, Kevin's property value has risen to roughly $340,000. His mortgage balance has dropped significantly. His total equity may now sit somewhere around $180,000. On paper, Kevin looks extremely successful. And honestly, he is. But remember what came attached to that success: debt, stress, repairs, management, unexpected costs, concentration risk. Everything tied to one property in one neighborhood. Meanwhile, Messi's investment account sits around $170,000 to $180,000 depending on market returns. The difference? Messi reached this point with almost no ongoing effort. And this is where the debate becomes genuinely fascinating. Because after 10 years, the results are surprisingly close. Real estate did not destroy index funds. Index funds did not destroy real estate. Both worked, but they demanded very different lifestyles. Now let's move to year 20, because this is where long-term investing reveals its true power. Kevin's property is now worth somewhere between $450,000 and $500,000 depending on appreciation. His mortgage is nearly gone or fully paid off. His equity is massive. Over 2 decades, he also collected rental income consistently. But after subtracting repairs, vacancies, taxes, insurance, renovations, maintenance, and unexpected costs, his total actual profit from cash flow is much lower than most people imagine. Still valuable, still wealth building, but not effortless, not magical. Messi's index fund portfolio after 20 years reaches somewhere around $420,000 to $460,000 with average historical market returns. And here is the shocking part. His total contributions were only around $122,000. Everything else came from compounding. Time created most of the wealth. Not labor, not tenants, not leverage, just patience and consistency. Now here is where the math changes dramatically. Imagine Messi increased his monthly contribution from $300 to $500. That small difference increases his portfolio to roughly $550,000 to $600,000 over 20 years. This is one of the biggest advantages of index fund investing. Scaling is simple. You invest more. Scaling real estate is much harder. Usually it means another down payment, another mortgage, another property, another tenant, another set of problems, another layer of stress. Now, to be fair, we also need to talk honestly about the stock market, because stock investing is emotionally difficult in ways people underestimate. Market crashes are brutal. In 2008, the market dropped around 37%. In early 2020, it crashed more than 30% within weeks. Imagine watching your portfolio lose tens of thousands of dollars rapidly. Most people say they will stay calm, but many panic sell at the worst possible moment, and that destroys long-term returns completely. Stocks also do not generate large cash flow early on. A total market index fund might produce only 1.5% to 2% in dividends. That is nowhere near replacing a full-time income. And unlike real estate, stock investors cannot easily use large amounts of leverage safely. They also miss out on certain tax advantages real estate investors enjoy, like depreciation. So after all this, who actually wins? The honest answer is this. Both strategies can absolutely build wealth. Real estate works exceptionally well for people who want leverage, understand local markets, can handle debt responsibly, do not mind active involvement, and are emotionally comfortable dealing with problems. Index funds work exceptionally well for people who value simplicity, want diversification, prefer liquidity, want low stress, and trust long-term compounding. Neither investment is perfect, neither investment is automatic. Both require discipline, both require patience, and both become dangerous when people only focus on the attractive parts. Because the internet loves certainty. But real investing is about trade-offs. Every investment gives you something, and every investment asks for something in return. Real estate may give you leverage and cash flow, but ask for your time and attention. Index funds may give you simplicity and freedom, but demand patience during terrifying market crashes. And maybe the smartest investors eventually realize something important. This was never supposed to be an either-or decision, because many wealthy people eventually combine both. Owning strong cash-flowing real estate while consistently investing into index funds creates a balance between leverage, cash flow, diversification, liquidity, and long-term growth. But most people never reach that point because they spend years arguing online about which investment is better, when the real question should be, which investment fits your personality, goals, stress tolerance, and lifestyle? Because wealth is not just about numbers, it is also about how you feel while building it. And the next time someone confidently tells you, real estate always wins, or the stock market is obviously better, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that actually matters. Thanks for watching, and I'll